Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Adam Hughes, CEO of Amount, Bob Brown, founding partner and head of investor relations at Motive, and Michael Perrin, partner at Curql Fundl. We're here to discuss Fintech fundraising in 2025 and what the opportunities and challenges are for investors. It is great to have everyone with us. Welcome to Trade Talks. Let's go around the horn here. Adam, we'll kick it off with you. Give us a sense of where your company, where you sit within the fintech ecosystem.
Yeah, thanks, Joe. Great to be here. So Amount, we are a software platform. We partner with banks and credit unions to help them modernize the experience around opening things like deposit accounts, loan products, credit cards, et cetera. Something that has been historically very manual for them. And to hit the customer expectations, they've now had to modernize here pretty dramatically. Yeah,
they certainly have. And Bob, tell us about Motive.
Sure, thanks for having me.
Of course.
I appreciate it. So Motive is a fintech-focused private investment firm. We invest from venture, growth, and buyout. We have 2 funds currently. We launched our first fund in 2018. We now have $6 billion of AUM, so it's been quite a run for us. We're investing across North America and Europe as well. We're focused very much on B2B infrastructure like financial technology assets.
All right, and tell us about Curql.
Awesome, thank you, Jill. So Michael Perrin, partner at Curql. We are a strategic investment fund focused on fintech, but most specifically bank tech. Now have a bit over $500 million of assets under management and on our second fund.
Yeah, well, let's talk about the fundraising environment for a moment here, because there have been a lot of opportunities and challenges for startups, certainly in the past 5 years. Let's talk about that. Is there a rebound? Is it starting to become more encouraging, the environment?
Absolutely. Just in the past few months since the election, we've seen quite a bit of additional deal flow, honestly. In our opinion, it was the election that was really the demarcation point, that especially earlier stage companies that were needing to raise but could wait a little bit longer generally did wait a little bit. And so once the election came, they did finally need to raise and so came to market. So have seen quite a bit more in the earlier stage. However, when you see more deal flow, we aren't the only ones with a checkbook. Other firms do tend to perk up, and so have seen quite a bit more competition in the market. And whenever you see more competition, valuations do go up. So yes, more deal flow, but generally we have been seeing valuations increase a little bit.
Right, well, Bob, let's take a step back for a moment here. Who is funding fintech?
So fintech really is funded across the board from strategics, corporates, venture capitalists, and private equity firms themselves. Obviously, last year was a bit of a recovery, but it's been a tough few years for fintech, and largely driven by investors focusing more on profitable companies and away from growing businesses. I would say coming into this year, I think there was a lot of enthusiasm for where it would go. I think in the last few weeks, we're probably sitting back and waiting, and there's a little more pause out there. I do think, however, that financial technology, as broadly defined, will be a sweet spot for investors. We live in a long-only world. It's very hard to be invested if you're not long, and fintech is going to be less impacted by these more generally than many other industries.
Yeah, and you know what's interesting, Adam, I'm going to talk about Bob. He made the point here that we're looking for profitability and governance and better balance sheet in this type of environment. It feels as if it has matured a bit, the space, and that valuation reset needed to happen for that reason.
Yeah, I don't think it's a bad thing to expect companies that you're investing in as investors to be profitable. For Amount, it's been a bit of a roller coaster because we've raised capital across every year over the last 5 years. I became CEO and actually started the company January 1st of 2020. Pandemic hit 3 months into my tenure, so that was interesting. Thankfully, QED, Nigel Moore's former co-founder of Capital One, his firm was the first check into the business. Then Goldman Sachs, Curql Fundl in the fourth quarter of 2020. 2021 was a bit more frothy, as we all know. 2023, big pullback. And then, last year, a bit of I think a healthy reset. Initially in 2021, more focus on growth than profitability. I think where we sit today, I'm hearing a lot of profitable growth. Is really what investors want to see. They want to see that 20% year-over-year growth, but they also want to see a clear path to profitability.
Yeah, I think investors should be discerning.
Yeah.
Right? At the end of the day.
100%.
And looking for scalable solutions, not just being a fintech for the sake of being a fintech, but providing a solution to a problem that exists and meeting the client
They want to see big TAMs, they want to see true product market fit, and they want to see real innovation that can really solve real world problems.
Yeah, and Bob, from your perspective, investor preferences, how would you summarize what they're looking for?
I would say similarly the case where profitability has been the focus. And importantly as well, cleaning up some of the sins of the past. You know, very, very high rapid growth rates and CEOs and founders being rewarded for raising capital at a multiple of revenue growth rates leads to elements of obfuscating some risks and issues. So there has been cleanup that's been happening with existing portfolios, and quite clearly investors are being much more diligent today.
Yeah, and Michael, you had said that the focus really is on later companies that have proven traction. Are there other areas within different stages where you're seeing opportunity?
You know, in 23 and 24, there was certainly quite a bit of focus on those later stage businesses. You know, as their public market counterparts, their valuations were somewhat depressed. We were finding some better deals in the later stage companies. However, just in the past few months, there's been a bit more of a focus on the early stage. However, having said that, whenever we see later stage companies now, we are always wanting to take a good look at them. You know, they're closer to profitability, if not profitable already, closer to maybe doing an IPO. And then of course, you know, we want to return capital back to our investors, and those later stage companies, generally speaking, are closer to that. And so that's always music to our ears.
What about sector trends?
Okay, so our firm focuses exclusively on bank tech. We see 4 main trends. The first is around AI in cybersecurity and fraud. In today's market, you know, there's obviously AI everywhere, but also being used by fraudsters and criminals. And so they are able to commit these crimes a lot quicker and more efficiently themselves. And so especially for smaller and medium-sized institutions that cannot build those technologies themselves, they have to go out and buy them from other technology companies. And so, you know, spending a lot of time, you know, looking at businesses in that space. Also, anything around operational efficiency, also leveraging AI for, once again, smaller and medium-sized institutions. They do have the opportunity to automate some tasks like, you know, loan processing, you know, back office operations, et cetera, and AI can be a very good use case for that. And then finally, for any FI, maintaining that net interest margin is always going to be critical. So technologies around lending that can help FIs lend more efficiently or profitably are always going to be things that are, you know, on trend. And then finally, collecting deposits. You know, institutions need those deposits as their lifeblood of their organization. So finding new technologies that can help generate them is always important.
Yeah, and Adam, you think bank tech is having a moment as well?
Yeah, I do. You know, I think we are already seeing a bit of an acceleration, but the pandemic really woke up banks and credit unions that they really need to modernize. They really needed to see an acceleration there because, you know, customer expectations have really changed. Customers want that bank experience from their mobile phone. They want to be able to open things like checking and savings accounts, apply for a credit card, apply for a loan product, get that immediate response versus going into a bank branch, wasting 6 hours of their time sitting in that branch. And so the top 5 banks really do these things themselves. So banks like Bank of America and Wells, you know, I think everyone outside the top 5 really struggles to build these capabilities and really invest in innovation themselves. And that's really where a company like Amount comes in, can help them dramatically accelerate and leverage our world-class platform.
Yeah, and you're seeing multiple opportunities, Bob, in different areas.
Yeah, absolutely. So we too focus on the banking and payment space, but in addition to that, capital markets, data and analytics, insurance, and then wealth and asset management. And I won't pick on banking because we've covered that a little bit here, but a few others. In the wealth and asset management space, there's a generational shift of assets. There are different types of investors coming in. That Netflix experience that everybody seems to want to have with their assets, which really is not there yet today, creates a great opportunity. In addition, and I know this is a topic that you've had various guests speak about in the past and will in the future, alternatives moving into wealth increasingly. You know, you'd probably be amazed to hear that until recently, the ability for a wealth advisor to open an alternatives account for a client was almost impossible. You had to open a broker-dealer account. You couldn't have a separately managed account. That technology is the backbone, infrastructure, accounting systems of these businesses. That's a great opportunity. In capital markets, here we are. It's large, complex, highly regulated, and still very inefficient. So you probably wouldn't be surprised to hear hundreds of millions of dollars are spent by each of the broker dealers every year in this thing called post-trade clearing and settlement. A lot of swivel chair jobs still going on in that space, so a lot of manual activities there. And then the final comment I'll make is on data and analytics. an asset class unto itself, it seems today. But importantly, in addition to the fact that more than 400 million terabytes of data are created every day right now, is the fact that data analytics backbone is key to creating proper AI-driven models going forward.
Yeah, and you had brought up that point before about cybersecurity, and I'm hoping that these newer companies are taking a cyber-first approach.
Sure.
Right, because you want to move fast, you want to get yourself into the marketplace. We saw that happen with generative AI, whether it was internal, external-facing products. But at the end of the day, particularly when you're working with highly sensitive data within the financial realm, as an investor, I would be looking at their cyber and data governance.
For sure. If a company isn't involving AI in some degree, especially in cyber and fraud prevention, that's an issue. So we're seeing quite a bit of activity in companies leveraging AI to help financial institutions defend themselves. Absolutely.
Yeah. Is it a challenge though, as a startup, because the technology is moving so quick? Is it going to even be relevant in 2, 3, 4 years from now?
Yes, it's moving quickly, but honestly, they're able to develop quickly. Like I had a meeting just yesterday with an early stage business, just has a handful of developers, and they're able to generate new technologies in a matter of weeks or months. So yes, things are moving quickly across the board, and so I think we're going to adapt and change for the better. Yeah,
and Adam, we're seeing that in the TradFi and DeFi spaces as well, where there's no longer this ethos of us versus them.
Yep.
And the integration is necessary for the nimbleness of a startup, but you need the scalability, right, of the larger firms. But we can't ignore the elephant in the room, and that's the economic factors. How is the macro environment influencing deal making and funding activity?
Yeah, I think it's a bit of whiplash here, but again, we've been dealing with it over the last 5 years as well, so we're very used to the changing landscape, and again, it really focuses, it forces you to focus on unit economics, making sure you're building a really sustainable business, right? So what I will say is, coming out of the election in November, I heard almost universally this was a moment in time, IPO market was open, M&A market was going to go gangbusters, and obviously we've seen a big pullback here in the last 30 days with multiple companies delaying their IPO, M&A market a little bit choppy. I still think the best companies are getting deals done. We've seen several in our space. Most recently, FIS bought a company called Dragonfly, a payments company. Alchemy, a digital banking platform, bought a company called Mantle. And so we are certainly seeing businesses transact, but it really needs to be focused on filling a clear gap for that particular acquirer.
Yeah, and I would imagine, Bob, too, the type of assets within the portfolio and what their exposure is to tariffs, as an example, is a big factor.
Yeah, exactly. As I mentioned earlier, financial technology should be less impacted. There are going to be some second or third order impacts for sure, but actually some are going to benefit in the capital market space. Companies that are processing trades. Increased volume means they're processing more trades, and they're actually doing better in those environments of increased volatility itself. And I do think that that's going to end up benefiting financial technology more broadly, as investors see that it's a bit of a safe haven from some of the issues raised by the tariffs.
And Michael, you bring up an interesting point that the interest rate fluctuations don't have as much of an impact on early stage investments.
That's correct. Generally speaking, those companies are potentially a full economic cycle away from monetizing, and they're also less likely to have debt on their balance sheet, and so interest rates are a bit less impactful on them. However, interest rates have a huge impact on later stage companies. Those businesses generally do have debt on the balance sheet and are also more susceptible to public market fluctuations. And obviously with higher interest rates, that impacts public markets, and that then related to lower valuations for some of those later stage businesses that were more susceptible.
Yeah, and Adam, there's a silver lining to this. I mean, you became CEO January 2020.
Yep.
I mean, the past 5.5 years almost.
Yeah.
Not only is everyone thinking about migrating to the cloud, then you have COVID, then you have supply chain issues, and then we go through 2 elections in that 5-year period. Yep. If you can operate successfully in that environment and be able to adapt, chances are.
We certainly think so, and across the way, adding significant value to our clients. We started with big banks, and so clients today include banks like TD Bank, Fifth Third, American Express. We've now more recently gone into the credit union segment, where there's 5,000 plus credit unions that need to modernize their technology as well. And so, keeping your head down, focusing on building that product market fit, really focusing on innovation, ultimately is the winning strategy in our view.
Yeah, I want to shift gears as we wrap up here. I want to talk about regulatory changes and associated challenges, because in addition to tariff uncertainty, we're also going through an uncertain regulatory environment as well, as it becomes more nuanced.
Sure. Yeah, I think we certainly are very mindful of regulatory changes around things like big data, AI. we really take the approach, especially with AI, in terms of responsible AI. And so, our goal is to embed AI and insights into every single thing that we do, both internally as well as for our clients. So internally, obviously, leveraging capabilities like Copilot and chatbots to make sure that we are driving efficiency within the organization. And then for our clients, launching things like our AI policy optimizer at Amount, where we're surfacing those insights around things like pricing strategy, fraud prevention capabilities, underwriting, that our client data science team can dramatically accelerate their analysis and then still go through that same governance process to make sure that we're being responsible.
Yeah, and what's so interesting, Bob, is data privacy and AI governance is going to be paramount for a number of reasons, but it also comes down to the competitive landscape as well. It's clear from this administration that innovation within the AI space and emerging technologies in general is a priority. So it's going to be a balancing act there.
Absolutely, and I think as it comes back to focusing on the companies themselves and how they're going to interact with that, one concern that we would have, and we focus on this with our portfolio company CEOs, is around the ability to navigate that uncertainty. Subscale organizations have a much more difficult time paying for the cost of regulatory uncertainty across whether it's data privacy, AI, or importantly also compliance from that perspective itself.
And then you also have multiple jurisdictions as well, not just within the US, but if you want to operate as a global company, the EU AI Act, I mean, the lessons learned from GDPR, while we might not have a specific framework in place, I'm hearing a lot of following the EU AI and GDPR standards, which are similar to California, similar to Colorado, operate at the highest level. This way you're not having to put it together piecemeal. Are you hearing something similar to that?
Absolutely.
Yeah.
That's exactly the way they're going.
Yeah. And so, Michael, I see here in your notes, you're an optimist, especially
yes.
Investing in early stage companies. How are they navigating what is a complex regulatory environment?
For sure. So earlier stage companies, obviously there will be some regulatory impact on them. However, in our view, we're looking for companies that are going to have a huge ROI on financial institutions, either their employees or their underlying customers. We like to see that a company or a technology is being pulled in by its customers, that if it's really able to generate the ROI that they say it can, it should really be selling itself. And so with an ROI that's that huge, we really think that it should be able to transcend and break through any sort of near-term regulatory issues.
Yeah, so in the last couple of minutes here, I want to get your each of your outlooks here. Michael, when do you think, if you had a crystal ball, that it's going to, the pipeline is going to open up? There's a lot of pent-up demand. You can see it in the public markets, the IPO pipelines.
I think it's going to get started in the coming months. Investors want to put money to work. We are out looking for deals all the time, and so whenever people are investing in businesses, capital is going into them, they're continuing to grow and develop those great new technologies that really society needs. And when those companies really become mature and are ready, the market will be ready.
Yeah. Are you optimistic? Let's call it the second half of the year.
We are, I would say, slightly paused in optimism for the moment versus what we start off the year at. But ultimately, the noise in the marketplace will settle and investors will come back to focusing on what they need to accomplish. If you think about the M&A cycle, we've already heard deals being done, more activity in that space. When you think about it from a private equity perspective, private equity has been inactive in new deals. It's been lower than it should have been relative to capital to be invested, and also in generating exits. And in fact, private equity over the last 2 years has underperformed public markets. So we see that as an opportunity to return back to a more normal spread versus the public alternative.
All right, and Adam, we'll wrap it up with your outlook.
Yeah, cautiously optimistic as well. I think there's a lot of great companies that are looking to go public. There's a lot of great companies looking to raise capital. There's a lot of dry powder sitting in the sidelines. And so, hopefully we see a little more stability here in the short term, and I would expect that, capital would continue to ramp up in the second half of the year.
All right, we'll leave it on a positive note. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.